Have you ever wondered if there's an ETF that outperforms 99% of portfolios? In this video, I'll go over the 3 best performing ETFs that have generated investors thousands of dollars. I'll show you what makes them so special, how they've withstood every major market crash, and why you need to own them if you're looking for life-changing wealth. While the S&P 500 offers steady returns, it can take time to see significant profits. If you want faster growth, QQQ might be the better option. With an average annual return of 18% over the past 10 years, it's nearly double that of the S&P 500's typical 8 to 10%. If you're aiming to reach your goals quicker, QQQ could be the way to go. The Invesco QQQ ETF, often just called QQQ, is one of the most popular and widely traded exchange-traded funds in the world. It tracks the NASDAQ 100 index, which includes the 100 largest non-financial companies listed on the NASDAQ stock market. The benefits of investing into QQQ are its high growth potential. It focuses on the tech and growth sector, which have historically outperformed other sectors, especially during market rallies. By holding a basket of the largest tech companies in the world, investors are exposed to the massive growth potential in fields like AI, cloud computing, and digital media. The expense ratio of this ETF is very low, especially considering the high return it has generated. This keeps its costs down, which means more of your money stays invested working for you. It's also got exposure to industry leaders. You can gain exposure to some of the most dominant and innovative companies in the world, including tech giants like Apple, Microsoft, and Tesla, which are at the forefront of the global economy. Some of the top 10 holdings include Apple, which makes up just over 12%, Microsoft making up just under 11%, and Amazon making up roughly 8% as well. There's a lot of other big companies in there, like Nvidia making up just under 6%, and of course Google making up 5%. All of the top 10 companies held in the ETF are well recognized, well versed, and highly profitable businesses. It even includes Facebook, Tesla, and Pepsi as well, all held within the top 10. QQQ has shown strong resilience during market downturns and has typically been one of the first to recover when markets rebound. As tech stocks lead the change during market recoveries, the ETF tends to experience faster bounce backs compared to other broad market indexes. If you're a growth investor seeking to maximize capital appreciation, QQQ is an excellent choice. It's designed to capitalize on the growth of the biggest and most innovative companies in the market, making it ideal for long-term investors who are comfortable with volatility. For investors who prefer a set and forget strategy, QQQ offers a great option. It's a passively managed ETF that you can buy and hold for years, providing you exposure to some of the world's best performing companies without having to actively pick individual stocks. Look, let's be real, most people lose money on their investments because they don't understand the game plan. If you don't know how to pick the right ETF or understand what makes them tick, you're basically tossing your cash into the wind and hoping for the best. But here's the good news. With just $100 and the right strategy, you could actually become a millionaire. If there was a well-oiled machine proven to keep steadily printing out dollar after dollar, would you buy a new one or keep the machine as it is? That's why the second ETF on this list is the S&P 500. It basically represents the US economy. It includes 500 of the largest publicly traded companies in the United States, covering roughly 80% of the total US stock market capitalization. It serves as a benchmark for measuring the performance of the US stock market and is often used by investors to assess the health of the overall market. Many mutual funds, exchange-traded funds, and pension funds track or mirror the performance of the S&P 500. Historically, the S&P 500 has delivered an average annual return of around 10%, including dividends. Since its inception in 1957, of Of course, returns vary greatly in the short term, but over the long run, it has been a strong performer for investors. With $100 per day invested across 33 years at an interest rate of 10% per year, you would have invested $158,000, but then have a portfolio valued at just over $1 million if you keep that standard average return in mind. The S&P 500 index is routinely rebalanced to ensure it reflects the largest and most representative companies in the market. Companies are added or removed based on factors like market capitalization, liquidity, and sector representation. For instance, Tesla was added to the S&P 500 in December of 2020, reflecting its rising prominence in the market. Some of the top 10 holdings for VOO include Apple at 7%, Microsoft at 6.5%, and Amazon at 3%. There's also some other big players involved like Tesla, Berkshire Hathaway, Nvidia, and Google. Facebook, along with Johnson & Johnson, are also held in the top 10. Despite experiencing major downturns like the dot-com bubble, COVID pandemic, or 2008 financial crisis, where the S&P 500 dropped 57%, this investment has demonstrated remarkable long-term resilience, consistently reaching new highs after major corrections. This makes it a preferred investment choice for long-term investors. The next ETF strikes the perfect balance, delivering both impressive returns and reliable income with one of the most attractive dividend yields on the market, making it potentially the best ETF on this list. The Schwab U.S Dividend Equity ETF is a popular exchange-traded fund that focuses on high-quality dividend-paying stocks in the US market. Managed by Charles Schwab, SCHD seeks to track the Dow Jones US Dividend 100 Index, which is composed of 100 high-yielding US stocks that have a record of consistently paying out dividends. Some of the notable benefits of SCHD include its high dividend yield, typically in the range of 3 to 4%, making it an excellent choice for income-focused investors. The ETF invests in companies with a track record of paying reliable and increasing dividends, providing regular cash flow to its shareholders. It focuses on high-quality US companies with strong fundamentals such as consistent earnings, solid cash flows, and low debt. Many of the holdings are blue-chip stocks which have proven their resilience over time. This focuses on high-quality companies and helps to reduce risk while providing income stability. Some of the top 10 holdings include Johnson & Johnson at just over 4%, Texas Instruments Inc. at 4%, Home Depot at 3.6%, Pfizer at 3.5%, Procter & Gamble at 3.4%, Coca-Cola at 3.3%, and PepsiCo at 3.2%. Cisco Systems is also in there at 3.10%, Merck & Co at 3%. And lastly, there's McDonald's at 2.8%. SCHD provides broad diversification across a range of sectors, including consumer goods, healthcare, utilities, financials, and industrials. This diversification helps reduce the risk that comes with investing in individual stocks, while still allowing investors to capture the performance of dividend-paying companies across various industries. It also has a low expense ratio of just 0.06%. SCHD is one of the most cost-effective dividend ETFs available. This low fee means that more of your money is working for you, and it reduces the drag on your overall investment returns. It has a consistently strong performance with an impressive track record of a solid performance. Over the long term, both in terms of capital appreciation and dividend growth, the ETF's focus on high-quality dividend-paying stocks helps it perform well even during market downturns, as dividend-paying stocks tend to be more resilient in challenging economic conditions. SCHD allows investors to automatically reinvest their dividends through a dividend reinvestment plan, or DRIP. This helps compound returns over time, as dividends are reinvested to purchase more shares, which in turn pay more dividends in future periods. SCHD doesn't just focus on dividend yield. It targets companies with a history of dividend growth, meaning the companies in the fund have regularly increased their payouts over time. This feature makes SCHD an appealing option for investors seeking to build wealth through both income and growth. ETFs are solid, reliable investments offering diversification and steady returns, but they can't match the explosive potential of assets like cryptocurrency. Take Bitcoin for example. Following its 2020 halving, Bitcoin soared from around $8,500 to $60,000, a 600% return in just 1 year. While ETFs are like the steady, reliable engine of your portfolio, crypto is more like a rocket. It can shoot for the stars, but it's volatile and high risk. If you're looking for high returns, crypto can offer that, but be prepared for a bumpy ride. For more on the best crypto investments, how to buy it safely, and the top strategies to succeed, make sure to check out this video on screen now.